You ever wonder how the world's wealthiest people, I'm talking billionaires and their families, actually invest their money? It's a fascinating question, right? It gets into strategy, legacy, and frankly, a totally different financial playbook than most of us are used to. All right, let's dive in.
Exactly. I mean, you wouldn't, right? When you're dealing with that much capital, you're not just investing anymore. You're building a financial dynasty. And that needs a very specific, super sophisticated plan. So today, we're going to pull back the curtain and see exactly what that plan looks like.
So, the first piece of this whole puzzle, and honestly, it's the foundation for their entire strategy, is something called a family office. This is basically the command center for their entire financial universe. So what is it exactly? Well, think of it like a private in-house company whose only client is one single ultra-wealthy family. It handles, well, everything: investments, taxes, charity, even planning for the grandkids. It's all about putting some serious professional structure around all that capital. And this quote from a recent Goldman Sachs survey really gets to the heart of why they do this. This isn't about what the market's going to do next quarter. It's about investing for generations. The whole point is to make sure the family's mission and their money is still around long after they're gone. Okay, so you have this long-term generational mindset. How does that actually translate into a portfolio? Well, this is where their strategy takes a massive turn away from what the average investor does. They are making a huge bet on private markets. 42%. Just let that sink in for a second. That's the average amount they have in what are called alternative assets. In the US, it's even higher, 46%. Now, most regular folks might have 5, maybe 10% in alternatives, if that. The ultra-rich are playing a totally different game, with almost half their money outside of public stocks and bonds. So what in the world are alternatives? It's kind of this big catch-all term for anything you can't just go buy on the stock market. We're talking about owning pieces of private companies, lending money directly to businesses, hedge funds, venture capital, basically assets that are pretty illiquid. You can't just sell them with a click of a button. Which, brings us to the big question. Why? Why would you tie up so much of your money in these complex, hard-to-access investments? Well, the answer tells us a lot about a fundamental shift in how wealth is being created today. And here's a huge piece of that answer. Companies are staying private for way, way longer. Just a decade ago, a company would go public in under 7 years. Today, it's almost 11 years. That means all that explosive early growth is happening before the company ever hits the stock market. So to get a piece of that action, you have to be in the private deals. And within that private world, there are a few areas that are especially hot right now. Private credit is massive. That's where they're essentially acting like a bank and lending directly to companies. Secondaries are also really popular, which is a clever way to buy into mature private companies from earlier investors who want to cash out. And then you have these passion assets, like sports teams, which are cool because their value doesn't really care what the stock market is doing. Now, just because they're diving deep into private markets doesn't mean they're ignoring public stocks. Not at all. In fact, their stock portfolio is a really critical tool, but they use it for a very specific job. And here it is. For the super rich, the number one job at the stock market is to grow their money faster than inflation over the long run. It's about preserving and hopefully increasing their purchasing power for generations to come. That's its strategic role, pure and simple. So where are they placing their bets in the stock market? The data shows they are really concentrated in 4 main sectors, and the logic behind each one tells a pretty cool story about where they see the world heading. First up, and this is probably no surprise to anyone, is technology. Family offices have been seriously upping their investments here. They see the explosion in artificial intelligence not as just some passing fad, but as a fundamental, world-changing revolution that they absolutely have to be a part of. And get this, that big bet on AI connects directly to the next sector, energy. Why? Because the whole AI revolution runs on an insane amount of electricity. All those data centers need massive, reliable power. So their focus on energy isn't just a classic bet on oil and gas. It's a direct bet on the infrastructure that's going to power AI. Healthcare is another huge focus, and this one feels very long-term, very legacy-minded. They see a chance to be on the cutting edge of innovations that could cure diseases and totally change how we live. It's an investment that offers financial returns, but also lets them have a real impact on the future. And finally, we've got financials.
With interest rates potentially shifting and the IPO market hopefully getting busy again, they see a lot of opportunity. When there are more deals happening, well, that's good for the big banks and asset managers, and they're positioning themselves to ride that wave. All right, so last but not least, let's look at how they hedge their bets. And this brings us to a really fascinating contrast between one of the oldest stores of value on the planet and one of the newest. And the distinction they make here is crystal clear. They look at gold as a safe haven. It's that physical store of value they run to when they're worried about things like geopolitics. Crypto, on the other hand, they treat it as a pure risk-on asset. It's a speculative bet they hope goes up, not something they use to protect themselves in a downturn. And you can see this thinking right in the numbers. About a quarter of these family offices are actively buying gold. They're leaning into that traditional role as a portfolio stabilizer when things get choppy. But then, look at this. A third of them now have some exposure to crypto. And that's way up from just 16% a couple years ago. So even though they see it as speculative, a growing number are clearly comfortable putting a little bit of their portfolio on the line. Probably because you have a lot of ex-hedge fund managers in these families who are just more comfortable with that kind of volatility. Okay, so after taking this peek inside the pretty secretive world of family offices, what can the rest of us actually take away from all this? What are the principles here that might apply to, any investor? So what's the playbook for us? Well, first and foremost, they are incredibly disciplined. They stick to their long-term plan and only make small, strategic tweaks around the edges. They are also super thoughtful about how much cash they might need, their liquidity, they use stocks to beat inflation, and yeah, while they love alternatives for growth, they really understand the risks, especially the fact that you can't just sell these things overnight. These are pretty timeless principles for building wealth, for sure. And that leaves us with one final big question to chew on. As more and more of these alternative assets become available to everyday investors, are we starting to see this playbook open up for everyone? Or do the sheer scale, the exclusive access, and the ultra-long time horizons of the super rich mean they'll always be playing a different game? It's definitely something to think about.